One of the key phrases that we're seeing being researched and actually asked by our clients is, what does it mean to be tax efficient? And this is a multi-step process, but really it's broken down into three categories. So pre-tax, after-tax, and tax-free. So the first piece that we're going to look at would be pre-tax assets. This would be 401k plans, qualified retirement plans, thrift savings plans, 403bs, IRAs, assets that you're putting money into before you pay taxes on those dollars. So if you're putting in money every 2 weeks into your 401k, it's going in pre-tax. It continues to grow and compound tax deferred. And then when you get to retirement, the goal is that you're taking it out possibly at a lower tax bracket. That's not always the case. So with pre-tax assets, to really identify tax efficiency, you have to look at what future tax rates are compared to what tax rates are currently. You also have to take it a step further and say, what does my future income look like? And with required minimum distributions in particular, we have to pay special attentions to these assets. So I have multiple accounts and multiple clients that we're managing that they're making more money in retirement than they did while they were actually earning an income during their working career. What that means is as these pre-tax assets continue to build and get bigger and bigger and bigger, you're eventually going to reach the age of what's called required minimum distribution. As you're forced to take distributions based on your life expectancy, every year you get older, that distribution rate gets bigger, meaning it's a larger tax liability that you could possibly incur in retirement, which works opposite of what we're thinking when we're putting that money away pre-tax. So for being tax efficient, right, on those pre-tax assets, we have to take multiple steps into planning. The second piece we look at is what are called after-tax assets. After-tax assets are monies that you received into your checking or savings account after your paycheck and then invested or saved in some other form of after-tax account. So for example, you open a joint account with your spouse, put $10,000 into that joint account. That $10,000 that you put into the account was already taxed. Now looking ahead, any monies that continue to grow and compound, right, you would pay what's called a capital gains tax on that growth. So if you sell something less than 1 year and 1 day, that means you pay short-term capital gains. That would be taxed at ordinary income. If you sell something that is after 1 year and 1 day, that would be a long-term capital gains. That's taxed differently. But what's interesting about after-tax assets is the taxes can actually be managed differently, meaning that if you have a loss that's a long-term capital loss, it can be offset with a long-term capital gain. It helps mitigate that tax liability through what we call tax loss harvesting. In addition to that, these assets that are after tax as they grow typically get what's called a stepped up cost basis at the time of death. So for example, if a client put $100,000 into an investment account, held onto it for 20 years, that $100,000 grew to be $500,000, they pass away, their beneficiaries inherit that asset at the value of the date of their death, meaning that $400,000 of gain is actually forgiven in that example. That can be something that's very powerful from a planning standpoint. In addition to those after-tax assets, also remember that not all investments are created equally. One of the main pieces we have to look at with after-tax money in particular is the larger the investment becomes, you have to look at what product you're investing in. So for example, if you're investing in a mutual fund that has high turnover inside the fund that you're unaware of, that's called the tax trap. So what happens is they're buying and selling inside the fund on holdings they might have had for 10 or 20 years, and you're now paying a capital gains tax even if your account went down. So it's something you definitely need to pay attention to additionally on after-tax funds. The third facet of tax efficiency is really where most of our clients would like to, be, and that's called tax-free. Realistically, you can't get all your funds in a tax-free bucket, but as much as you can is ideal. So tax-free instruments would be something like a Roth IRA, a Roth 401k, something that you paid money on already, or paid taxes on, when you put it in, and that growth continues to compound tax-free. In addition to that, there's no required minimum distribution from a Roth IRA during your lifetime. When we look further beyond that, there's also strategies that you need to start exploring on how to take advantage of that pre-tax money when you're in a lower tax bracket and possibly shift it over to those after-tax or tax-free funds, right? Roth conversions are a strategy we talk about all the time, and it's simply looking at the math saying, where can I pay the least amount of taxes and does it work for my situation? In addition to that, life insurance is another way to pass assets onto your loved ones 100% tax-free. And what we found is as clients continue to live longer and longer and expenses get higher and higher, it can honestly be treated as an asset class of its own to fill that bucket up for the next generation. So many clients are utilizing some of these RMDs or funds that they don't know how to spend, but they're forced to pay taxes on, and simply shifting them over to a tax-free bucket that's going to fill that inheritance back up for their loved ones, then obviously continue to build that nest egg going forward. So tax efficiency has multiple layers that we need to go through, and it's a question that needs to be assessed individual by individual and also account by account.